Are you a government employee planning to retire or resign? If so, one crucial aspect that you need to consider is getting your taxes in order. And let me share with you a story that highlights why this is so important. I recently dealt with a member, we'll call him Malcolm, who reached out to me because he was feeling frustrated that he had left over 6 months ago and he still didn't receive his money. And although I didn't help Malcolm with his initial planning, I was curious to see what was causing the delay. Now, I remember sitting down with him, going through his paperwork, and as we were analyzing each of the documents meticulously and investigating the possible issue, after a thorough review, I discovered the problem. Malcolm hadn't filed his tax returns for over 3 years. And this small issue caused a major oversight on his part, a major delay on his part. Although Malcolm had opted to retire, this also applies to members who want to resign. Now, do you want to ensure that you avoid delays with SARS when you retire or resign? Stay tuned because in this video, I'll be sharing with you 3 secrets to ensure that your retirement or resignation is smooth and help you to avoid those delays with SARS. Now, let's get started straight away. The first secret that I want to share with you is submit your annual tax returns and make sure that you submit this on time, every time. So let's understand how the tax system operates. We know that a tax year, the financial year, starts from March of a year and goes up to Feb in the following year. So it's March to Feb, that's a calendar 12 months. So the end of the financial year is the end of February. Now what you want to make certain is somewhere around July is when tax season opens and you're allowed to start submitting your returns. So keep in mind that you're submitting your returns here in July. It's actually for this previous period where the tax year ran from March to February. Now, when you're submitting your return, you want to make certain that the return is properly filed. So pay attention to a few things that you can sort of look out for, right? One, SARS does an auto assessment. And usually it's the case, well, the system's improving significantly. So more and more South Africans are getting it structured in such a way where they're auto assessed by SARS. How does this work? Think about all the banks, think about financial institutions, when you earn your salary, think about all the institutions where you are earning what SARS defines as income, even if it's unit trust and you're earning interest, capital gains, all of that. By law, you would receive a certificate. So take, for example, your medical aid. You would receive a certificate, a tax certificate, and then a tax certificate is also sent over to SARS. So SARS is aware of this, and this is how the auto assessment can take place. Because in essence, what they're looking at doing is they already have the information, they're just trying to quicken the process, right? Now, there are instances where you might not have the information easily supplied. So as a second one, keep in mind, you might collect, let's say, a rental income. And if you are collecting a rental income, then it means you have to start to disclose the rental income, right? Meaning you're going to have to tell them how much you've earned, what was the period that you earned. And in addition to that, be mindful. Again, you can chat to your accountant for this, but there are certain expenses that you can write off. So keep in mind the first thing, and this is a sort of easy way, it's auto-assessed, in which case you want to log in on your e-filing profile. If you're happy with the return, you proceed with it. If there's something that you are unhappy with, then you notify SARS and you say not to go ahead, right? And you can always submit it manually. The second thing to keep in mind is sometimes, if you don't get auto-assessed, it could mean that you're getting some sort of income from another source, right? So it could be a rental income, or sometimes, for example, if you have, say, a late spouse, and now you're collecting a spousal income. So it's another form of income, in which case SARS may not necessarily auto-assess you. But whatever the case is, you want to ensure that your tax returns get filed and they get filed properly, right? You could do this by an accountant if you want, or alternatively, you can have this done directly with SARS. Or you could do it on your own, right? If you're confident with how to get this done, you can do it either one of those 3 routes. The essential point is to make certain that your annual tax return gets filed. If it doesn't get filed, this can cause a delay because SARS is uncertain whether you actually owe them any money. So when the process is happening, whether you retire or resign, SARS is going to apply for a tax directive, right, on your gratuity or your true 1/3 lump sum, depending if you're retiring or resigning. And that's where the hiccup comes in, because they're going to pick up that you actually haven't submitted the returns. It's not up to date. So let's start to look at step number 2. And step number 2 is critically important. Either route, again, whether you opting to retire or resign. And why this is such a crucial phase is you want to start to plan ahead for what is happening. Again, doesn't matter if you retire or resign. Because in either route, you're either going to collect a gratuity if you're aiming at retiring, or in the case of resigning, you're going to collect what I call the true 1/3 lump sum. Right? I explained in previous videos the differences between the two. And this is from a retire perspective. And this is from a resigning perspective. Right? So either route, what's going to take place is, as I shared with you shortly, SARS would want to assess the amount that's getting paid out, whether it's a gratuity, whether it's a true 1/3, it goes over to SARS and they issue what is called a tax directive. Meaning SARS would basically say how much of money they want to take for they taxing you and how much of money you're going to be left with, right? And then that payment would get facilitated thereafter. Now, why you want to plan ahead is in the case sort of applies more on the resignation side, because you can start to consider pre-98, right? It's an extra tax-free benefit. You can also start to consider the tax-free portion. Now, I'm using the tax-free portion that was applicable at the time of me shooting this video. Remember when you're doing this to make sure that you're using the latest tax guide that's available at the time. So the current tax-free portion is $550,000. So in addition to your pre-98, if you started before 1998, you've got the $550, right? So there are two tax-free portions here. Now, if you are aiming at resigning, I'm not saying that that is the route you have to take, but just giving you some sort of clarity, you want to make sure that you plan ahead so that you can structure this. Remember, with the resignation, it allows you the ability to adjust the amount that you're taking out. So you can adjust this in such a way that you're paying the least amount in tax, right? And if you're needing clarity on the pre-98, exactly how to calculate it, because the figures are not openly disclosed, you can always book a consult with me and I'll guide you with how to do it. Or view the testimonials that I have on the YouTube channel so that you see how other members are taking full advantage of the pre-98. It's a benefit that is essential that you must maximize. Now, what happens if you are aiming at retiring? You still want to make sure that you plan ahead, right? Because although you cannot adjust the gratuity, the benefit itself is sort of fixed. You want to start to be mindful of the amount of tax that you could be paying to SARS. So when you know the amount of tax that you're paying to SARS, you will sort of know how much is left behind, right? And then that allows you to plan yourself a bit more carefully. Now, keep in mind there's some hidden factors when it comes to SARS. So if you have a retirement annuity, for example, this could also interfere with the tax calculation. So make certain that when you are getting your tax planning done, and this is why I'm saying to you, plan ahead. The financial planner, or if you're reaching out to me, I'll know exactly how to plan this. But we must take into account the retirement annuity, whether you've withdrawn money previously or not, or you just have the current retirement annuity, or you have multiple retirement annuities. All of that must be considered in order to ensure that you basically pay the least amount of tax possible. Now, the next thing I want to share with you is please save copies of these tax directives. Let's go back to see where the directive comes into play, right? Say you are aiming at retiring, the gratuity gets applied to SARS and SARS would issue a directive, and the directive is basically saying how much of tax you're going to pay. Once that directive is issued, it is cast in stone. It cannot be changed, right? You want to make sure that you save a copy of it though, because sometimes SARS might request it, right? If there's an issue for whatever reason, SARS requests it and you don't have it, that can cause a delay and you don't want to get into any type of tax issue. So if SARS requests it, you want to make sure that you have this on hand. Now, in the case of resigning, you're transferring your money out in cash. If you're going to head that route, don't go that way, ideally, because remember, you're going to pay a fortune in tax. But again, if you are cashing out, SARS is going to issue a tax directive, which again, you need to ensure that you're keeping a copy of that tax directive. If you're following the guidance that I've shared inside of the YouTube channel and the masterclass that I've created, you're transferring this money to an approved fund, the perfect approved fund. You still then, from the approved fund, can access up to 1/3. So when you are accessing up to 1/3 of your money, this still means that SARS will get involved and they would create a tax directive. When they create the tax directive, what are you going to do? Correct. You are going to save a copy of this tax directive because if SARS requests this in the future, you have it at hand. Now, although this doesn't impact you for your retirement or resignation, it's sort of post your retirement or resignation, you still want to make sure that you have it because you don't want to have an issue again ongoing, right? Whether you choose to retire or resign, you're still earning an income, you still will be needing to submit tax returns until it gets to a stage that SARS says it's okay, you don't have to submit the return. That's it for this video today. I hope that the video has been helpful for you. If you have, give me a thumbs up. That's going to make me happy. And I know then that the information is helpful and guiding you along your journey. And if you've not already done so, why have you not subscribed? If you have, thank you so much. Remember to share this amongst your friends and your colleagues so that all members inside of the government community can be empowered to make better financial decisions. I'll see you in the next video.